Hello, everyone. Welcome back to Algo Trading Conference 2022. It was a wonderful session by Dr. Thomas Stark a few minutes ago, and I hope you all have thoroughly enjoyed it. For the second session of the day on regime definition, Triage between bulls and bears, why it simplifies the work, we are joined by Laurent Bernut from Tokyo, Japan. Laurent is CEO at Alpha Secure Capital, and he's an expert in short selling trading strategies. Hey, Laurent, are you with us?
Good evening, good night, good morning. This is a
Thank you
global
so
session.
much. Yeah, good evening. Before you start, Lauren, a quick introduction about Laurent Bernut. Laurent is the founder and CEO of Alpha Secure Capital. He was worked in the alternative investment space at Fidelity Investments, Rockhampton, and Watt Ferry. At Fidelity, his mandate as a dedicated short seller was to underperform the longest bear market in modern history, Japan equities. His research to generate alpha in the alternative space has been built on his expertise in universally tested systematic trading process. So, Lauren, I'm making you the presenter now, and you can
Thank
continue.
you.
Thank you so much.
Thank you very much. So, good morning, good evening. Thank you very much for this introduction. It's an honor being here today. Yeah, frankly, an honor. I'm delighted to be of service and to be of help to QuantInsti. Congratulations for your second anniversary. And to be honest, I feel a little bit like Kung Fu Panda, like or Master Ogué and all these famous people all around. It is really good and somewhat intimidating to be here today. So without further ado, today we're gonna talk about regime analysis. So what is it? By the way, the $100 trillion Zim dollars, I have that note. So I scanned it. So officially I'm a trillionaire. Um, so there's no need to go through who I am. So we'll go through that. This is my country of origin, New Caledonia. This is a book I published. I'm also an instructor with QuantInsti, 2 decades. So introduction, the word regime definition. Triage is a word that was coined during the Napoleonic war campaigns. Today I've done two bucket lists. In the morning, I kite surf during a typhoon in Japan, and at night I talk about l'empereur, Napoleon. So triage was a word that was coined in the field hospitals during the Napoleonic War campaigns. The idea that they had limited resources, limited time, and fewer doctors, so they had to make very quick decisions as to whom they could discharge without operating, the people who could operate, and the people who were beyond hope and let go, unfortunately. So translate this to the market. The market equivalent of triage is regime analysis or regime definition. What is bullish, what is bearish, and what is inconclusive. And once you've done that analysis, and it doesn't have to be long, it doesn't have to be complicated, as we will see, it will simplify the world. Everything will fall into 2 or 3 buckets at max. We will answer a very simple question, simplify your workflow. So as l'empereur said, take time to deliberate, but when the time for action comes, stop thinking and go in. So regime analysis, what is it? As a great Chinese philosopher, so first things first, the program of the evening is what is regime, why it matters, why you need to care about it, and methodologies. So as the t-shirt says, stay humble or be ready to be humbled. So by the end of this evening, the framework of tonight is articulated upon a recent appendix or update to the short selling course I did with QuantInsti. And because I'm a better programmer now, I literally built the file I wanted to have 10 years ago. So we'll see regime in action, and I will explain it through the chart that we have here. So this file, I really wanted to have it 10 years ago. It would have changed my career, literally. So I built it. It's a global screening across asset classes, across markets, like about 20 equities market, cryptos, forex, futures. When you name it, it has multiple signals that are synthesized in easily digestible bits of information, properly visualized. Information is really aggregated, is compelling. It generates signals in USD, in local currency, in USD, or whatever currency you choose to be. In absolute, in relative series, benchmark adjusted. It calculates beta, it plots a bunch of charts, everything. I mean, you have 3 drawbacks though. Number one is processing time. 2 hours is long. Number two, position sizing. The module of position sizing is not yet included, and there's a reason behind it, but I won't get into it. And number three, unfortunately, doesn't brew a strong coffee. Apart from that, it has pretty much anything you want. So let's show the results. You show the results to your boss, and it'll make you happy. Like it basically with that kind of file, it will take away the need for like rows and rows of sector analysts, as we will see later. So let me go through the chart and explain further. So the black line that you see is the price of the index. We take to Nikkei 225. The green dotted line and the red dotted line are basically the percentage of stocks that are in bull territory and bear territory in absolute series, like using the standard price, not benchmark adjusted, not currency adjusted, just the raw number. So as you can see, the green dots follows the shape of the index, and at the moment, after some time in bearish territory, you can see that the green dotted line moves up. Now the blue line is the gain expectancy. So gain expectancy is very simple. We took the score of all the regimes, calculated a horizontal average, and then divided into bullish and bearish using the average score and the percentage. We calculated gain expectancy. So with that gain expectancy, that gives us basically, if it's above zero, market is like solidly bullish. If it's below zero, it's bearish. As you can see, the gain expectancy tends to peak before the peak of the index, or concurrently, I should say, and around the time it bottoms out. Now, this gain expectancy goes through the absolute, through the relative, altogether. And the cyan line, the light blue line that we see, is the absolute. So as you can see, this one is much more nervous. It peaks with the number of issues in the market and so on and so forth. So it's much more nervous, much more reactive. And why did I choose Nikkei 225? It's quite simple. It's because Nikkei 225, unlike other markets, this looks bullish. So you can see a disaggregation of the signal across the score across a lot of markets, except for Nikkei. So I thought it was interesting. This is why we showed it in here. We'll come back to it. So what is regime? Number one, as the great American philosopher Rocky Balboa used to say, time takes everybody out. Time is undefeated. So regime in absolute is simply price goes up, price goes down, goes nowhere. So we are bullish, bearish, and inconclusive. Now, very few asset classes can only be traded without the index. These are futures, ETFs, Forex generally, although Forex is usually pegged to the USD more or less as the big pairs. But very few asset classes can only be traded in absolute. Even crypto, for instance, can be traded versus Bitcoin. So what are relative series? And this is something that we're going to spend a little bit of time talking about. Yes. So relative series are basically the OHLC, open, high, low, close, divided by the close of the benchmark. And this can be further currency adjusted. And then what you have then is you have outperformers, the securities that outperform the benchmark, or underperformers. So for people who are in the equities, this is basically what is outperforming the index, the eternal quest to find the outperformers, and then apart from that, like those that underperform. So for all the stuff that is, what should I say, market cap weighted, these are more or less equally divided. So on the chart that we can see on the right-hand side, we can see black line. So this is S&P 500. And the straight line is in relative the number of outperformers in red and green. So as you can see, it oscillates around the mean. And this, bear in mind that this is the S&P as of today's constituent. So it doesn't adjust for addition and deletions. So it has naturally what is that? It has I forgot the name of the bias. But it has a bias in it, so it's a bit late at night. So as you can see that it oscillates, like the number of outperformers and underperformers roughly oscillates around 50%. On the other hand, when you look at the absolute, terms, you can see that actually the number, as the market rises, the number of securities that go up increases while the number of securities that go down in absolute comes down. So this has an important impact when we talk about long ULA. Sorry, let's go back to ULA. My apologies. I hope you can see the screen. This has an important impact when we talk about long-short equities portfolios. Basically, long-short equities portfolios are the net result of two relative books, outperformers on the long side and the performers on the short side. And with this, the delta of those two, this is how you basically aim for the outperformers on the long side and aim for the underperformers on the short side, and the delta of those two generates the performance. So first things first, there's a classic misconception of like, oh, this is absolute performance, therefore we should be looking at stocks that go up in absolute and stocks that go down in absolute. As it's clearly shown in the chart, the stocks that go down in absolute in bull markets are few and far between, which means that they are what we call crowded shorts. So you'll be basically hunting the same stocks as everybody else does. Besides, as it shows on the very top skeleton, you'll be a laggard indicator. And there's no worse insult in our profession than be called a laggard indicator. And I never felt in a good opportunity to remind the people of this. The idea behind this is before a stock goes down in absolute, first it underperforms its peers. So it's immediate competition. You have Canon that makes photocopies, you have Ricoh. Canon outperforms Ricoh, fine. Or you have Toyota versus Nissan or whatever that is. Then, okay, this one outperforms or underperforms. So, okay, it underperforms its immediate competitions. Then it underperforms its industry. Then it underperforms the sector. Then it underperforms the broader market. And then finally, it goes down in absolute. So by the time the information has traveled, you've paid a quite hefty price. By the time the stuff starts to go down in absolute, it has already been underperforming for some time, which means that the cost of borrow will be more and more expensive. So you'll have to pay up for this. Plus, you'll have to compete with a bunch of tourists who don't know how to sell short. Meanwhile, if you stick to relative performance, what you will see and what we'll see in the charts very soon is that actually, instead of focusing for stock that is going up or down, you focus on sector rotation. What sectors are outperforming? What sectors are now rotating and underperforming, rolling over and underperforming? So as we will see, for instance, very soon we'll be talking about, We'll be talking about the shipping companies in Japan. They've been going up. They are performing, and these are late cyclicals, and they don't. Every now and then they outperform, and then they crap out for the rest of the time. But basically, by focusing on, or another example would be tech. Tech about a year ago, or actually a year and a half ago, I mean, everything you touch would double, triple, no problem, give me a bunch of spikes and so on and so forth. Now, today's all these are radioactive. So this is this kind of sector rotation. And it's much smoother and much easier to work with because, as you can see, a whole pack of stocks, sub-industries of stocks moving. This is what you should be focusing on. Another thing as well is it's also an arbitrage on beta. As we will see, and this is also in the file, this is where I think it's a couple of things on it. Beta is the covariance matrix with the index. So as you see, for instance, when you design a portfolio, a long-short portfolio, you will see that, for instance, in bull markets, you tend to have high-flying stocks, high beta stocks on the long side, and low beta stocks on the short side. During transition, what you can do is like reduce the exposures, but then you still keep the same stocks in the bear market, except they switch side. You have the low beta defensive food stocks and so on and so forth, all the different utilities and so on and so forth, all the high dividend, like super defensive stuff. You put them on in the long book, and in the short side, you put the high beta, the high flying stocks that usually give up a lot of performance very quickly. So the leaders on the way up also tend to lead on the way down. Moving on. So why regime matters? Now that is an interesting question. All right. Our performance is defined as the excess returns over the index. And so basically your paycheck, your employment, your career, your life on the market is a direct function of your ability to generate excess returns. And as the Australian post-apocalyptic road poet says upstairs, hope is not a mistake. No, hope is a mistake. It's not a proper strategy. So if there's one takeaway that you should really take away and embrace and really uh, try and work with is like the chart of like the bar chart that we see. What we see here, the red line is the benchmark. I think it was the S&P 500. And then underneath, like under and over, are the percentage of active fund underperforming their benchmark year on year. So 50% is the average. And as you can see, the overwhelming majority of active managers underperform on 1, 3, 5 years. So generating excess returns is critical for your survival. So even a basic understanding of what it takes will really make a difference. Without further ado, let's do it. Let's say, for instance, if you perform whatever analysis, whether it's fundamental, whether it's quantitative, whether it's quantamental, whether it's technical, whatever that is, if you don't do some basic regime analysis or regime definition, you operate from a place of where it should go down. Like I've seen a lot of fundamental analysts throughout my career of saying why stocks should go up or down. And yeah, the classic examples, for instance, would be shorting rich valuations. Like everybody has been, everybody, their grandmother and their dog have shorted Tesla at some point in their career. And everybody's been taken to the cleaner. So it's not because something is hopelessly is like as ionospheric valuations that is going to go down. On the other hand, same thing with tech. For instance, tech, you couldn't short it 2 years ago. And now let me check. Actually, let me tell you. I just had this idea. Let me look at my other computer. For instance, it was Shigatsu Nanoka. Okay. For instance, you couldn't. I did a round trip on a SOCL, which is like the ETF of social media, and I went long. I think it was on March 27th, 2020, and on Shigatsu Nanoka, July 7th last year, I went short. I mean, and the difference between this and the other, what I wanted to say is that it's a regime analysis, the regime change. I changed my. People often say when the situation changed, I changed my opinion, and this is and regime analysis is a good way to look at it. For instance. So shorting rich valuation doesn't guarantee that things will go down. They will, but you might lose your shot until then when the momentum doesn't work. And when the market agrees with you, it becomes very easy. Another classic example of people, and I've seen that a lot with value, especially with value and devalue guys, is value traps. But it's cheap. Yeah, don't worry, it's gonna get it. But don't worry, it's gonna get cheaper. So value traps is usually stocks that are cheaper than their peers, that have slower earnings growth, that have high dividend yield, and that have decent balance sheets in general, but they're still underperformers. So you always think, why doesn't it go up? It has all the valuations, all the stars are almost aligned, except they commit the ultimate crime in a Keynesian beauty contest called the stock market, which is they're boring. They're not sexy. There's no story. So yeah, they might be cheap, but don't worry, they're gonna get cheaper relative to their peers and so on and so forth. There's something more attractive. There's a better story out there. So when you don't do regime analysis, synthetically you're taking a business risk. What is the business risk? Is you might be right eventually, but it's not wise to test the patience of investors. The market might stay wrong longer than your investors will stay with you. So that's an important point. And as we will see, it's super easy to do a regime definition. On the other hand, when you do a regime definition, you don't operate from a place of why it should go up or why it should go down. You observe that, okay, this is outperforming, this is underperforming. So now the only question I need to answer before I get in is why? And usually there are three types of answers. Number one is, let's say something has gone up a lot, a stock has outperformed the market, and now it's taking a break. So it's a consolidation. All right, we've outpaced everybody else. All right, time to take a break. Let's get off the car. Let's get off the highway. Let's get off the car. Go to the toilet, have a Coke. Let's take it easy. Let's have a lunch break. And then it will resume our course. So that happens quite a lot. The second thing is, as we mentioned before, is sector rotation. The sector rotation, for instance, is when you see a whole industry moving in unison. Like today, I ran the file I was talking about for tonight, actually, and just to paste some charts. And in there showed up like Mitsui OSK, Nippon Yusen, and there was a third one I forgot. So you can see that there's an entire industry that is moving up, where the average score, the bullishness is growing. And I checked this industry versus the land transportation, and the land transportation is doing nothing as pretty as this one. So as you can see, like when there's a sector rotation, you can move along. It's very easy. You can see, oh, same sectors in the same sub-industry are moving. So all you have to do is, okay, which horse I'm gonna race? Makes it very easy, simplifies the work. And the third type of answer that usually happens, wait a minute, so we have all these stocks moving up. Example, classic example. Well, all the tech stocks and social media are moving up. Well, Twitter is going nowhere, or MySpace is going nowhere. Well, then if all the sectors is moving and this one is not moving, then it's stock specific. Then it's time to do some fundamental analysis, dig deeper, and so on and so forth. So as you can see, this regime analysis really simplifies the workflow. You don't have to, oh, this one should go up, this one should not go up. You have your triage made, like, okay, these are the underperformers, these are the outperformers. Why? And then it's fairly easy to drill. Okay, this is moving, momentum is moving, blah, blah, blah. Valuations are still expensive, but there's growth. Here we go. So it really simplifies the work. Really, really, really. And also it makes it more objective. You're not trying to finesse the market. You're not trying to argue or negotiate with the market. The market does the heavy lifting for you, and you're just what you should be, a servant to the market. All right, moving on. And this is a fairly short presentation. So I would like to move on to Q&A fairly rapidly. So the methodologies are fairly simple. As the great Chinese philosopher Bruce Lee used to say, the height of perfection runs into simplification. So the methodologies have been there forever. So there's nothing new under the sun. These are the classic breakouts. So breakouts is it's like the staple of technical analysis is breakout from consolidation, is breakout from the Donchian channel, is the turtle traders, which is asymmetrical. You'll see like in the file, all these, and in the course as well, everything, all the formulas, like it's 1 or 2 lines of code at worst. So the good news about the breakout is that it's conceptually super simple to understand. And you can see it in the chart. It's usually the light green under the blue and green prices. We'll come to those charts later on, but I just would like to explain the methodologies. So conceptually, breakouts are very simple. Like over a certain period of time, you have either a breakout on the upside or breakdown on the downside. So it's very useful when there's a consolidation, when the market has gone sideways for some time and it breaks out or breaks down, that is usually a very good signal that something is about to move. It works in absolute, it works in relative, no problem. Now it does really well in those cases. The drawback of this is that there's by definition an inherent built-in lag. That means that basically you'll have to wait. Now, for instance, let's say you have a breakout of 100 days. I know very few people who have the patience to wait 100 days before they reduce the position or even close the position. So this is something you have to juggle with. So the turtle traders, for instance, are the dissociated or asymmetrical entries and exit. They are the long waiting time and a shorter duration band to get out of stocks. That basically is very useful when you want to capture small profits in sideways market. I've heard also of other trend followers who have the other way around, where they have shorter entries, shorter duration entries, and longer exits for you to test to reach his own. And the second methodology is moving averages. So moving averages is interesting. Like this really, this illustrates the picture that we have. It's like giving glasses to people who are colorblind. It's magical. As you can see on YouTube, that it's really heartwarming to see this on YouTube. Like people who, for the first time, can see colors. And moving averages are a bit like this. I think it's an interesting analogy, where you have a sterile chart and then you put a moving average. Oh, it's going up. Oh, it's going down. It gives context, if you will. So there's always a constant argument over durations. Like, to me, it's a hallmark of choice. Oh, should I use a 20? Should I use a 30? Should I use a 50? Yeah, well, bonnet blanc, blanc bonnet, as we say in French. So it really depends. Now, the drawback of moving averages is, by definition, it's noisy in sideways markets. It's very choppy. So when the moving averages flatten out, this is where people give back a lot of performance, of slippage, transaction costs, and so on and so forth. So the good news about moving averages, and a good use of moving averages, is to exit positions. Now they cut, if you will, like the drawback that we had, the breakouts. The moving averages do a much better job at exiting earlier on. So combining those two, actually, there's probably something to be done there. Now, so we're talking about like the single moving average is usually for longer duration. If we're above the 200, for instance, then we're bullish. If we're below, we're bearish. But you can't exactly write a trading strategy. So people have usually done dual, like double moving average crossover, but also because there's a lot of giving back a lot of performance, some people do triple, where there's a long-term moving average and then a medium term and short term for entry and exit. So you'll see that in the file line, nothing new under the sun. Higher highs, higher low. Also, the type of moving averages, they can be simple, exponential, triangular, weighted, you name it. To each your own, try and test. So higher lows. So this is interesting. This is something that I really liked for a long time, and then the market proved me otherwise. So the market is a bit like life, if you will. Life is what happens to you when you're at other plans. And in theory, it seemed like a good idea. In practice, it was not. So higher highs are low means basically that when, well, as it says, when the market makes higher highs and makes higher lows, this is trending up. When it makes lower highs and lower lows in that order, that also implies that the market is trending down. So it's very intuitive, if you will. It's computationally taxing. It's not easy. In the file, there's a new algorithm for fractals. Quite happy about it. So it can do that, the higher highs and the lows. And not in this file, but you have the swings to do it. Like you can even see on this chart, like these are the small dots, marginally bigger dots, and then triangles. So triangles is fractal level 3, small dots is fractal level 1, no, fractal level 2, and you have this in relative and in absolute. So unfortunately, as I said before, the market, it doesn't necessarily work as planned. I mean, it is logical, but this series can be fairly erratic. The good news is that you enter a long trade on a low, and you close it on a high, on a swing high, and vice versa on the short side, where you would enter on a high and close on a low, right? So this is interesting. Then finally, my favorite, and this is in the course, this is the floor and ceiling. So conceptually, the floor and ceiling is the right shoulder of the head and shoulder pattern. So how does it work? Actually, let me explain. We're going to be using our favorite SoftBank. I think everybody's heard about of SoftBank. So when you see let's say for instance at the beginning you see a blue triangle and then you see another green triangle. This basically the blue triangle marks the lowest low. That's the floor, and then you can see that it makes that there's a dot, a green dot, and thereafter it's painted in light blue. So this means that it marked the bottom and then there's a higher low. Conversely, let's find a ceiling. So as you can see, there's a spike and a pink triangle, I guess. And right after that, you can see a pink dot. So that says, okay, we marked a peak, and then all the subsequent swing highs were lower by 1.5 standard deviation. This means that the price fails to take out the new high, which means that basically, well, we're either sideways or bearish. So as you can see, the floor and ceiling is conceptually superbly easy. Okay, there's a higher low. That is like there's a materially higher low. And there's a materially lower high. Everything in between, from here to there, is bullish. Everything thereafter is sideways or bearish. There's only bull and bear. This is conceptually superbly easy. It works. The good news about this is that it works across asset class. It works across time frames. It works in relative, absolute. It's I like to refer to it as the Kalashnikov of regime definition. Like it fires regardless of how inhospitable the conditions are, the terrain, whether it's freezing, whether it's raining, whether there's sun, whether it will still fire. The drawback, though, is that it's computationally taxing. So it's not a one-liner. It actually splits into, there's one thing that the fractal base that does the swing definition, and then there's another analysis that comes on, there's an overlay, the regime definition. So it's computationally taxing. As you will see, this is why the file takes 2 hours to run. So now let me go back to this chart of SoftBank. So we talked about all the methodologies, and this chart basically prints them out. So it uses a library called, I think it's MPL Finance, Matplotlib for Finance. You can find it on GitHub. This one, it has the absolute and relative prices. The small dots that you see are the fractals level 2. The triangles are fractals level 3. You can see the multiple moving averages, both in relative and absolute. The light blue and the light pink like surfaces areas, the floor and ceiling. The areas that move like light green and light salmon that follows price are the breakout and breakdown, and the turtle as well. So have I missed anything? I don't think so. All right. Then in panel 2, you have something, it's called the score. The score is basically the average of all the regime definition methods. So the composite that I wanted to talk about is basically, well, which one is better? Is it breakdown? Is it moving average? Is it higher highs, higher lows? Although I don't use that here. Is it floor and ceiling? Is it floor and ceiling level 2? Is it floor and ceiling level 3? Is it absolute? Is it relative? I don't know. It's complicated. I need chocolate and shoes. All right. Calm down. So score is basically, the score is the average along the horizontal axis of all the methodologies in both absolute and relative. That's very simple. So in general, the relative prices precedes least absolute. But what you can see here, and this is kind of interesting to watch actually, because we take the horizontal average along the horizontal axis, you can see that as all the methodologies agree, the score oscillates between +1 and -1. So when it's really bullish across the board. So what you could do with this idea of the score, this is also something that you can see with Robert Carver. He has a similar methodology, probably more advanced, where basically you can tally up the methodologies to get a score. And when all the methods agree together in both relative and absolute, the score goes up, and vice versa. Now, what is interesting to see is when there's a divergence between absolute and relative, the score goes to 0, and you can see that with SoftBank from I think it was in late 2020, where the relative was underperforming and the absolute was going up. Well, they don't agree, therefore the score comes close to 0. And then the relative got bullish, and the score went up, came down, and so on and so forth. So this idea of score is actually quite powerful. Now, where were we? So when the score is 0, means like basically the methodologies disagree. When the score is above 0, both absolute and relative agree, but the score is below is bearish. So this is pretty much it on methodologies. Now I hope I've this is something. Okay, so the gain expectancy, this is basically the appendix of the presentation. This is my friend Michael Covell and my friend Victor Agani. Victor Agani was a trader with LTCM. He did a spectacular exercise on position sizing. But what I wanted to show you here is gain expectancy is win rate times average win minus loss times average loss. So, and below is, of course, my friend Michael Covell. Everybody knows Michael. Fantastic guy. Great respect for Mike. So the reason why I wanted to show you this is because we're coming back to here, and this is the gain expectancy of all the methodologies. So within that file, you will see basically, let me copy this and you'll understand. Let me see if I can copy quick and dirty. No, probably not, but you'll have a charts like this for every single market that are traded that give basically an overview. Then you have heat maps. Then you have charts like this. So charts like these and those and so on and so forth. So I hope I've clarified the regime, and now it's time for questions and answer, Q&A.
Thank you for the presentation, Laurent. We will now start picking questions from the audience, and I will request everyone to put your questions in the panel now. Meanwhile, I would like to share about the upcoming anniversary sale. Starting tomorrow, we will be offering 75% discount on all Quantitative short courses. This offer will start early for all the conference attendees with additional benefits. Attenders of this conference can avail an additional 20% discount on top of the upcoming anniversary offer by using the coupon code, which will be displayed on the chat for the next 9 hours. All right, so we have the first question here. What is the logic behind regimes? Is it some algorithm like K-means clustering? Can you please explain a bit more on how to create or define regime?
Okay, good. K-means clustering. Okay, no, this is an interesting. That's an interesting way to think about it. This is not how I thought about it, but regime is something that people have talked about for a long time, and I didn't invent it. But the idea is basically to do. Let's go back to this chart, and I hope I can explain better. The idea behind this is the way I look at regime as a practitioner is very much okay. Let's segregate the market. Let's divide it between bulls and bears, and within that, let's look at the sectors. And you'll see when you run the file, it's basically okay. Let's divide. You know that the market, virtually all markets in the world are market cap weighted. So that gives you basically that half of the market will outperform the index, half of the issues will underperform the index. When you have like very simple stuff like this, it basically tells you which ones are outperforming, which ones are underperforming. So this is a preliminary to the rest of your analysis. It helps you focus on, okay, what are if I'm looking for longs, where should I be looking at, or what is the market rewarding? Is the market rewarding? Is high beta outperforming? Is high beta underperforming? What are the sectors outperforming, underperforming? So it helps basically scan all the market. I mean, when you run the fund, you'll have like hundreds of candidates every day out of 3,500 securities, but at least it gives you a profile of what you should be looking at. It's really much preliminary analysis. It's really the idea of triage. Okay, these are the ones that are performing. I'm looking for longs. This is where I'm going to do my shopping. Make sense?
Thank you, Laurent. Hope it answers the question. Moving on to the next.
Excuse me, where can I see the questions? Can
On
I
the
see
panel?
the question? Yeah.
Yes. Yeah. The second question that we have is, can the regime analysis be applied to individual stocks or just to sectors?
Good question. Well, the regime is very simple. So let's go back to the chart and we go back to any chart, like whether it's a SoftBank. As you can see, there's something called score. It's on the panel 2. This works for this company, and the score for this company is, let me see, sorry, sometimes I speak in Japanese. The score is, for instance, minus 21, minus 0.21. So it's marginally bearish. You have the score of Mitsui LSK, which is 0.96, I think, or somewhere like that. So 0.36. So it's much higher. So you can score all the. This is just an idea, and there's also a body of literature, like for instance, Robert Carver uses. I mean, the idea I actually got it from him. I mean, I read his book, and then one day it dawned upon me that, yeah, well, I don't know which one was going to work better, so how about we put everything together and see what works. So it works on every single stock, and it works at the market level, so you can aggregate at the market level and have an idea. So let's go back to the first chart that we saw in the beginning. In the first chart that we saw in the beginning, you can see the gain expectancy in blue. So this is the broader market. Here we calculate the horizontal average. We calculate the horizontal gain expectancy. So it's day after day after day of the score of every constituent within the market. So for instance, for something like S&P 500, it will be 502. For FTSE 100, it will be 100 and something, Nikkei 225, and so on and so forth. You get the drift. Make sense? I hope I answered your question. If not, please continue. I'm here for you.
Thank you, Laurent. We do have a couple of more questions. We'll try to pick as many as we can. So there's another one here. In your long short equity portfolio, you plan to short weakest 5 and long strongest 5. You can also consider overbought and oversold and then filter out.
Okay. All right.
More like
okay.
information.
Okay, so that's interesting. So, all right, now this, okay. Whoa, I'm glad I included that in the presentation. All right, so here we go. So if you want to buy, okay, let's put this in. This is a fantastic question, and this is a question that probably would take about 10 minutes to answer properly. But I'm trying to give it. I'll try to give it as much as possible, as much justice as possible. So let's say, for instance, you want to short overbought. This is a classic mistake. If you want to short overbought and the context is bullish, what you will very rapidly be humbled is that actually overbought is very frequent for the stronger stocks in the market. It's not a sign that they're about to reverse and pierce the earth's crust. Overbought is a general condition. Conversely, stocks that are bearish, they become depressed, very depressed. So they are frequent flyers in the oversold universe. So if anything, you would find that RSI, classic RSI, tends to broadcast overbought stocks, bullish stocks as overbought and bearish stocks as oversold. Now, if you do some regime analysis, and then what you will also see with RSI is, for instance, RSI, whether it's in relative or absolute, you will see the same thing over and over and over again. For stuff that is in bearish territory, overbought means RSI of 60. For stuff that is in bullish territory, oversold means RSI of 40. So the average of the RSI is contextual, whether you're in bullish or bearish territory. And this is something that I've empirically observed over time. I mean, I've not written a white paper on it. I've certainly no interest in doing so. But this is something that with practice you tend to notice, like RSI travels depending on where you're looking at. So if, on the other hand, if you do a regime analysis, what the idea that you were talking behind this was probably buy on weakness, sell on strength. Again, it's contextual. If you do the triage upstream, you will avoid those false positives that you tend to encounter. I've been down the road that you're talking about, and RSI in absolute is it gave me a lot of grief. I hope I answered your question. And also, one more thing that I wanted to add. Now we're talking about, and we're going. The question behind the question was basically, should I practice mean reversion on the short side and trend following on the long side? Now, as you can see here, the P&L distribution by strategy, if you're doing trend following on the long side, you will have a right skewed, you will have a right tail, an elongated right tail. And if you're doing mean reversion, you'll be left skewed. So having left skew on the short side and right skew on the long side, it doesn't negate risk. It actually compounds risk. So what you'll very quickly understand is that actually, if you're practicing trend following on the long side, you need to practice trend following on the short side as well. Otherwise, your risk will be de-axed, which means that basically the reward won't work. Your risk will be very poorly hedged right around the time when you need to be hedged. I hope I answered the question. And I didn't do it justice. I apologize for this. I would love to answer the question if we had more time and have a debate if it was possible. But given the format, not today. Next question, please.
Thank you, Laurent. That was lovely. We have next question here from Prem Kumar. Do we hedge the right and left tail with options as well?
Oh, that's a good question. All right. So, okay. So, that's a good question. So you're talking about selling, you're talking about buying the wing, right? All right. So what's his name? We used to do that. We used to do covered calls. So covered calls is basically in the options world. So we're drifting a bit away from the. So covered call is basically you're selling options around the money, like within the plus minus 5% on a 3-month horizon. This is where you have the maximum liquidity, and then so you're short gamma close to the money, and this helps you finance the out of the money tails. So like, but if you're talking about hedging the distributions of the skew, I wouldn't do that. I wouldn't do that. Like if something is wide skews, yeah, I mean enjoy the ride. As Tom Basso always says, enjoy the ride. But if something is left skew, yes, you have a natural interest to cut the risk at some point. But to like buy the wings, sell the money. What's his name? The anti-fragile Nassim Taleb. This is his strategy. I hope I answered your question. If not, please send a follow-up. I'm here for you.
All right. We'll try to see if we can answer any more questions quickly. There's one question from Thomas. In the second chart, the one where you said SMA, HH, HL, what are the relative indicators there?
All right. Okay. This one, right? Okay. So relative indicator. So on the top, the blue line that you can see is the absolute price. So within the file of the course, if it's below 500 period, if it's above 500 period, it defaults to line chart. Below that, it defaults to OHLC. Simply, it's the way the library was written, so I just bypassed it. So what we have here, this thing can be as colorful as it is now, as you want, or as light as you want, depending on the type of indicator that you choose to print. So here we have moving averages. Let me put it on my workstation. Oh la la. Oof. So we have the triple line. I think double or triple line is moving averages. That's one. They follow the price, so no big deal. Then we have the dots. These are the fractals. Those are the swing highs, swing lows in red and green. If they are dots, they're level 2. If they are bigger dots and darker, they are level 3. If they're triangles, it's floor and ceiling, I guess. Blue and pink. So you have two series. You have the absolute, the relative. Then the larger surface that you can see, blue, super light blue with alpha of 0.1. This is the bullish floor and ceiling. From the time it got bullish, all the way up until the time it turns bearish, and vice versa for the light pink. Now, the light salmon, never trust a Frenchman with the color coding. The panel looks very, what's that, like pastel and all this stuff. Never trust a Frenchman with that. Otherwise, you have Monet and Giverny. So the light salmon and the light green that follow the price a bit like a trading range. These are precisely the breakouts and breakdowns, like rolling max and rolling min. And that's pretty much it, I would say. And in the second panel is the horizontal average of all the regimes. So I hope I answered the question. Again, same story. If you need more details, maybe I can do that in the file. So let me know, please. More questions. Come on, come on, come on. Let's sprint.
Lovely. Great energy, I would say. There's a following question by Thomas. He would like to know the name of the book that inspired you on regime analysis.
That's a good question. There was no book in particular.
Okay, all right.
But if you're referring to Mr. Carver is much more about the score that you can see underneath. So hold on, I have his book here actually. Well, type Robert Carver. He's coming up with a new book. I think he's written 2 books. We were actually in a conference together a couple of years ago. Great respect for this gentleman. So, and also you can go on his this blog is systematic. So it's his blog, and he also has a lot of Python snippets of code. All right.
All right,
Anything
so
else?
we'll take the last one for now. It's from Yash Vardhan. He's asking here, does monetary policy play any role in regime? Example, Japan printing money, so would that make Japan bullish?
That's a very good question. Well, you'll have your answer today we're the 20th, and today there will be the Fed. I can tell you I'm positioned, and it's definitely not the same color as my green screen. Trust me. So that's monetary policy. I was having this conversation with somebody. Okay, this is going to be an easy answer. I strongly believe that everything in this world is priced off the US 10-year. So it's either like either direct influence, like bonds, fixed incomes, and stocks. Either it's the first derivative, which is liquidity. Either it's the second derivative, which is sentiment, so risk on, risk off. And it's very simple. Don't fight the Fed. So when we've had the longest synchronous globalized bull markets, and every time the Fed said that they're coming off tapering and so on and so forth, the second derivative, which is sentiment market, tanked. And now they're raising the interest rates and so on and so forth, and they are struggling. And back in 2018, I think, I wrote something on Quora like, don't worry about the next bear market, worry about the one thereafter. The idea behind this is that the Fed, particularly the Fed, would burn the furniture if need be to make sure that they would not have a bear market. And so they did after 2020 and the pandemic. Like, money was free flowing everywhere. And they did a great job at it. The only problem is, when would they stop? So they fought obesity with rolling out free cheeseburgers and free Coca-Cola and freedom fries for everybody. The problem is, what would make them stop? So I think it was in early 20, no, November 2020, I wrote, there are three scenarios. Either they're going to wake up one day and say, oh, the markets are too frothy. Well, it has never happened in my lifetime. Either the bone vigilantes, Mr. Yardeni, will walk up and say, hey, come on, we're going to teach you table manners. No, this one is not going to happen. Or scenario number three, inflation, because the Fed has a dual mandate, which is employment and inflation, and no one wants to be back in the 70s. It was great music, but nobody wants to relive that period of stagflation. Nobody wants to relive Weimar. Nobody wants to be like Argentina or Latin America or Zimbabwe. So the idea behind this is inflation will always force the hand of the Fed. So it's not they might talk a tough game, but they will have to follow through. And when the rent of money becomes expensive, the first thing that suffers is all the risky assets, the second derivative, and then comes liquidity and so on and so forth. So the regime, in terms of regime, again, the regime does not have an influence over this. The regime tells you what the market is a reflection. The market is whispering this. So this tool, and this is why it took me a long time to build it, this tool just tells you this is where the market is. It doesn't have prospective value. It doesn't tell you like within a year they will do this or that. But you can very clearly see the sector rotation. You can very clearly see that. All right, for the vast majority of the markets, we're in bear markets. That's it. How long it will last? I don't know. Will it be nasty? I don't know. But I can tell you where we are and how, and you can position yourself accordingly. So sorry, it was a long-winded answer, but I hope I answered your question. So a very simple thing is, does it really does monetary policy have an influence on this? It does, but it just, of course it does. It tells you where the market does, but the tool that I built is just revealing it to you, if you will. That was a long answer.
All right, Lauren. Thank you so much once again. It was a pleasure to have you on the panel.
The honor was mine. Thank you very much.
You're welcome. We have also posted the link for the learning track on the chat, and we have received some queries about the code not working. We are looking into it, and it should be fixed shortly. Now, for the third session of the day on education in financial markets, structured approach and emerging trends, we will be joined by a panel of experts from India, Singapore, and Switzerland. So stay tuned, guys.